Just give me 1 second. Yeah. Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Dhiraj Nayyar, Chief Economist, Vedanta, former Head Economics, Finance and Commerce at NITI Aayog, joining in. Welcome to the show, Dhiraj, and always a pleasure to speak to you and get insights. Dhiraj, my first question coming to you is with the RBI policy decision that has just come in a couple of hours ago, and clearly they've maintained their stance. They've maintained, the rates as well. What do you make of it?
I think that was what I was expecting, and I think it's absolutely the right thing to do under the circumstances. We all know, challenge before RBI has been the rising inflation and at the same time, an uncertain recovery. What we've seen over the last few months is that the recovery has picked up pace, but we still in uncertain times. We have done a good job of vaccination. 25% of the population is double vaccinated. A significantly larger number has got one dose. So hopefully the COVID is not going to raise its ugly head in a big way. But with the pandemic and with a new virus, one can never say. So I think, given that RBI has to maintain its accommodative stance for a while yet, in my view, and keep rates low. Because at this point it's too early to call an end to accommodation and start reversing the cycle, because uncertainties still remain. And remember that even at the end of this financial year, if we do grow at 9.5 is what the RBI is predicting, then we will roughly be back at where we were before the pandemic. So despite the impressive rate of growth, we must remember that we are still playing catch up with the amount of time and GDP lost due to the pandemic. So in the circumstances, I think the RBI is absolutely correct. And I was expecting it, but I'm glad they have stuck to it.
Right. So overall, what's your anticipation with regards to growth and inflation? Because clearly, there's always been a dilemma whether the RBI should focus on inflation or should the RBI focus on growth? Because they've come out and said that they will ensure that inflation remains in target range. Do you think it could come in at the cost of growth?
Well, now that we have this monetary policy framework, it's very clear that the RBI's primary mandate is to target inflation. Now, we can have a separate debate on whether that's the right thing. I don't think, it was an idea that was in fashion 10, 15 years ago. But frankly, all textbook ideas lose traction in a time of extraordinary circumstances like we are going through right now, with the pandemic. And the inflation, to be fair, is not a demand-led phenomenon. So RBI can manage demand, so if it's because of excess demand, the RBI steps in. But the inflation is clearly on account of something else, supply disruptions, the high commodity prices, which is again partly a result of excess liquidity globally, not in India as such, because commodity prices are largely globally determined, not determined in India. So I think those are putting certain inflationary pressures on the economy. But the RBI, by trying to squeeze demand, will do nothing to address those. So I think the RBI, unfortunately, at this particular point, with the nature of inflation, which is coming from fuel, commodities, is not really in a position to clamp down on it. And if they, in fact, try and do it, what they will do is squeeze growth, and inflation will still continue. So what you will get is stagflation. So I think the RBI, much as though its textbook mandate is to target that inflation range, and they are trying their best. But I think interest rates at this point are a bad instrument, given the nature of inflation and given the reality on growth. I think the priority at this point, given the suffering that has happened, the economic suffering because of the pandemic, the priority has to be on growth, especially when that demand is still not where it used to be before the pandemic. Consumer sentiments, investment, these are all still well below the pre-pandemic level. So there's no fear at all, in my view, of excess demand, which is the only situation in which the RBI should react to today's interest rate.
Right. And overall, if you see, high frequency indicators have actually turned positive. Some have crossed, in fact, many have crossed the pre-pandemic levels. By when do you believe that the RBI will start raising rates, either reverse repo or repo?
Well, I would think that they would continue to hold the interest rate at this level, at least for the rest of this financial year. They may change their stance from accommodative to neutral at some point in the last quarter if COVID doesn't have a resurgence and if the recovery continues to sustain momentum. But I would suspect, and my view is that interest rates should remain where they are until we are absolutely certain that the recovery is firm and COVID is behind us.
Right. And overall, with regards to where the balance of payment is concerned, Q1 FY22, we saw current account surplus at 0.9% of GDP, and FY22 CAD is seen at 0.8% of GDP. What would you make of these numbers in terms of analyzing of the economy would be?
Yeah. So I have a slightly counterintuitive view. In my view, when we have a current account surplus and when we did have a current account surplus, it actually showed a weakness of the economy because, it actually showed a weakness of demand, that imports had fallen. Partly, of course, oil prices had also gone down, which is a major determinant of our current account situation. So I think it was more an indication of weakness because structurally, when demand is right, imports generally exceed exports in India. And I think now we are reverting to that normal. Of course, part of the pressure again is oil prices hitting $80 a barrel, and oil imports are about a quarter of our total imports. So that will always matter. But I think the robustness of demand and comeback of demand, it's actually showing some strength in the economy. So for me, the current account deficit is actually, I know we don't take a kind view to it, and I think, but at 0.8, I think it's showing strength in the economy rather than weakness. Of course, it's showing our vulnerability to oil prices, which is a structural issue and which has been with us for a very long time, and which we should address in a different way. But otherwise, for me, that surplus that was there a few months ago wasn't necessarily a sign of strength. I think this is much more a sign of robustness of domestic demand. So in that sense, I'm not unhappy about it.
Right. So, now that we're returning to a current account deficit regime, and along with it is the impending taper, how do you expect the rupee to trade? Do you think it will continue to trade with a depreciation bias? Because appreciating dollar is already beginning to put pressure on emerging market currencies at the margin. So what's your view then?
Yeah, so I suspect it will put some amount of downward pressure on the rupee. And in fact, every time you just analyze the data for the last decade and a half, every time oil prices go through the roof, we anyway have downward pressure on the rupee. And as you correctly said, this time around, there's the taper scenario as well. And in 2013, when it happened last time, we didn't cope well. But I think we are in a better situation, provided oil prices don't shoot above 100 or go up to the 120 sort of level, which I don't suspect they will. But otherwise, I think we're in a better position. Our forex reserves are plentiful. So I wouldn't worry too much. And a little bit of depreciation again. I'm again taking a counterintuitive view that I don't think it's necessarily a bad thing. If anything, it will give an added competitiveness to exports. And at the moment, if you look at the overall economy scenario, exports seem the best bet in terms of boosting our growth and employment and manufacturing. So I think, again, a moderate depreciation. I think what matters much more is that this should not be a shock. There should not be a dramatic depreciation and then appreciation. Volatility matters more than the level. So I think, we can manage that without volatility, which I think we are in a better position to do now than we were 7-8 years ago. So I'm hopefully optimistic that, we'll manage that better, and that some amount of depreciation is not necessarily a bad thing.
Right. So that's with regards to where, the impact of the current account deficit on the rupee goes. Now, moving on to the fiscal deficit front, if you take the period between April to August, we're at around 31.1% of the budget estimate versus 109% a year ago. Now, yes, there is support coming in by tax buoyancy as well as higher non-tax revenues. And the expected RBI dividend to some extent has also aided. Expenditure overall was weak. August 21 is when the expenditure has started to pick up as well. So in your view, how do you anticipate the fiscal deficit? Do you think there could be a slippage on account of, say, shortfall in divestment revenues, etc.?
Well, there's always a risk of that. Divestment revenues have been ambitious for a number of years, but the targets have not been met. Hopefully this time, if sales like Air India, BPCL, shipping corporations, there are some big ticket sales over there. Privatization, outright privatization, and then there's the LIC IPO, which may or may not unlikely to happen in this financial year. But there are signs that may happen. But at this point, again, my view is that for this particular financial year, we should not worry too much about slippage in the fiscal deficit. In fact, I think we should be worried the other way of expenditure being lower than it was the previous year. So sure, we are in a better position regards the pandemic and with regard to demand and sentiment than we were 1 year ago. But still, I think the economy needs the support of government expenditure, to complete the recovery in rapid time, and then move on from recovery back to our growth path. So I think I would not worry too much as long as the quality of deficit is not compromised, as long as we are not giving away freebies and spending unproductively. But if spending has to be done productively on infrastructure or on manufacturing investment, I think that kind of if that causes a slippage because say revenue falls short or disinvestment receipts fall short, I wouldn't worry too much about it in this year.
Right. And overall, if you have to look at the fiscal deficit as well, despite the tax buoyancy, there is a likelihood of a slippage, as you mentioned, about the risk on the back of the divestment target. However, how an impact would this be with regards to where the higher than budgeted RBI dividend is concerned, which could be partially offset by the moratorium on telecom receipts?
Yeah, so again, as I said, I think, in the end, you'll arrive at a certain number plus minus 0.5 of GDP, depending on the various, uncertainties that are there. So I would again say that we shouldn't nitpick too much and we shouldn't worry too much in this particular year, because this has still been, the second wave after all happened in this year. And, we are still not totally out of the woods. We don't know how COVID will behave come the winter months. So I think, again, I'm not one who would nitpick too much on the fiscal deficit number, plus minus 0.5 or even up to plus minus 1, I think is all right. I mean, I don't think, as I said, providing the quality of expenditure is maintained.
And overall, if you see in terms of the government's borrowing calendar as well, they've pegged the gross GSEC borrowing in the second half of FY22 at around 5 trillion, which is almost around 41 to 42% of the total. And they've kept the gross borrowing for FY22 at the budgeted 12 trillion on an average. What do you make of this number as well?
So, I mean, my point about government borrowing always is that it should be predictable and the market should know, exactly what is going to be taken off by the government. And, at the time when recovery is happening, and if, ultimately the main engine of growth in the Indian economy has to be private investment, government spending at the end of the day is, less than 20% of GDP. I mean, the consumption expenditure is in fact about 13-14% of GDP. So ultimately, this should not be a scenario where the government crowds out, potential private investment. So, but again, I think this year, I don't see private investment booming as such. It may recover and there may be some big ticket projects in the line. But again, I think that's something for next year. So this year, again, the only thing I would say is that as long as the government sticks to what it is saying, I think the market is expecting and all the players are expecting that much borrowing to happen, to sustain the recovery.
Right. So overall, Dhiraj, if the government does not overshoot with regards to budget on the borrowing, and if there is no incremental borrowing, which would then, bode well in terms of where yields are concerned, what's the kind of range we should be looking at?
So I mean, I'm not one for forecasting because there's far too much uncertainty even now. As I said, everything, all of these things can go out of the window if we have a third wave or even a half wave or something like that. So I think at this point, it doesn't make sense speculating on what the numbers may end up being later in the year or end of the year. I would still want to play it session by session, as they say in a test match in cricket. I think this is not the time where you can predict what will even happen on day 2 or day 3. I think such is the state of the economy. So I don't want to hazard any prediction right now on longer term numbers.
Right. And very lastly, Dhiraj, we recently had Moody's who's gone ahead and upgraded India's sovereign rating outlook to stable from negative. However, they've retained the rating at Baa3, which is actually reflecting the lowest investment grade rating. So what do you make of this? Because yes, there was a lot of excitement about the upgrade, but when you talk about the overall rating at Baa3, how would you advise someone to read it?
Yeah, so I think, again, you'll have to ask the rating agencies why they do what they do. But in my view, I think it's underrated. India is underrated. There are other countries, in the world which have far worse debt positions, far worse government debt positions, far lower expected rates of growth, which have a higher sovereign debt rating. So I think in that sense, I'm glad they've at least upgraded the outlook. But in my view, the rating should be higher as well. But again, I think, what investors look at the end of the day, and if you're asking me how one should read it as an investor, I think, again, India's prospects in terms of growth, in terms of, we are still, only a $2,000 per capita income country, 0.6 trillion GDP. So the potential is vast. And I think a lot of reforms have happened structurally in the last 18 months. I mean, the government has used the pandemic well to do some of the difficult stuff. So I think investors ultimately look at policies, investors ultimately look at what the rate of growth will be. Sovereign rating may be one part of what they look at, but it's not the only part. So I think investors should still look at, the other positive sides of the India story. And, in my rating agencies, maybe giving a lower than deserved rating because of, certain perception issues, or they think that governments in India can be, careless with fiscal deficit and so on. Though in fairness, again, to this government, they have not shown that kind of carelessness. In fact, they've been quite careful even through this pandemic. And many people were actually recommending a much higher fiscal deficit, much higher spending. So the government has been responsible, and I think the rating should be higher, but so be it. But I still think investors should be looking at other parts of the story, which include growth, which include the reform process, which include the divestment program. There's a lot of things happening in India, which if I was an investor would make me much more excited than, a particular rating that is being given right now.
Right. And very lastly, from here on, what are the key monitorables one should be looking at?
You mean in terms of what? Indicators?
In terms of indicators.
So I think we should, of course, be watching all the high frequency indicators, and we should have a very keen eye on, that COVID number. As long as it stays low and as long as our vaccination rate continues to go up, I think that's really what will be key. But, as we have seen in some other countries, there have been a very high vaccination rates, and there's still some resurgence of cases, though by and large, we see that the seriousness of the cases or hospitalizations or death have come down where vaccination has become universal. So I think, fingers crossed, in another month or two, we'll have done half of our population with double doses. And then, but that's something we still should watch out for. The COVID number, the vaccination number, and on the other side, of course, watch out for the real economy number. And lastly, watch out for that oil price. Because there are several indicators, current account deficit, inflation, even growth ultimately, which get affected by that. So watch out for that particular price also in the coming months.
Absolutely. These are important indicators we should be watching out for. Thank you, Dhiraj, so much for joining us on the show. Always a pleasure to speak to you and get insights from you. Thank you. Stay safe and speak to you soon again.
Thank you.